Hello, friends. Today we're talking about T Rowe Price, ticker symbol TROW. The stock is down year to date almost 15%, and they just reported not too long ago earnings. Right now, analyst says that it is a sell, and the target price for the next year it will be about $96.50, which is going to mean that for the next 12 months, if this is were to happen, you will only make 2%. So, are they right? I don't know. Let's jump into it. If you don't know who T Rowe Price is one of the biggest investing companies in United States. It's a global investment management organization. Most IRAs, more 401ks, more 401ks, sorry, are invested through T Rowe Price. They're very trusted, and one of the things that they do is they charge fees for those management. I will encourage you to get a little more information, more familiar with T Rowe Price. I want to jump. Most people know what T Rowe Price is, so I'm just going to be jumping some of the evaluations. But before I do that, I would like to remind you that I am just a YouTuber, and I do own T Rowe Price. I have a significant position on this stock. I will highly encourage you to do your own due diligence. Do not buy or sell anything based on what I say. This is just for informational and educational purposes. This is for me to just give my thoughts about the stock, give my bull or bear case, and I would love to hear from you. If you have not subscribed, please hit the subscribe button, or if you like this, or don't like it, just press the like or dislike button. And if you have any questions, comments, maybe something that I miss, maybe your bear case or your bull case, write them in the comment. I would love to hear from you. So thank you for watching, and let's continue. Like I said, they reported on October 27th, and they beat in EPS. They beat in revenue by 20 million. So I think that a lot of the bear idea here is that they think that people are gonna, because of the recession that is expected to come, which I agree that there was going to be a recession coming up in 2024. At least that's what I'm assuming when I'm making some of these projections and analysis. A lot of people are thinking that people are going to stop investing in their IRS or their 401k. And that could be true. But most companies, if you think about it, most companies, once you sign up, it's a whole pain in the butt to change that. Most people are just worried about what they're doing all the time, and they forget that because money just gets deducted directly from their paycheck, so it just goes over there. T Rowe Price gets their little fee, and they just move on. So I don't know how much they're going to be affected. I mean, even if they're affected right now for the next year, I'm patient. I have no problem waiting 1, 2, 3 years to see some of these turnarounds, and so that's my case when I'm looking and analyzing this. So when it comes to revenue, you can see that for the last 10 years they have been growing their revenue at about 8%. When it comes to earnings, they had a really nice growth, and I think that this is part of the reason why people are skeptical of what is going on, because in 2022 there was almost a 50% decline on earnings. So the average on their profit, let me just look at here the numbers, profit margins. They have been in the 30s to 40s, and then it dropped to 25%. And I think that if you were going to invest on this, I will encourage you to read the 10K or the latest 10Q I'm in the process of reading and see what is affecting the earnings per share. Free cash flow in 2016 and 17, a lot of companies were down. I think there was a little bit of slowdown on the economy. But other than that, and I think that this is why people are thinking that this is going to happen again in the next 2 years. So free cash flow is relatively steady. The margins are about, here says the average is 27%, but once again, whenever we go here, the free cash flow averages are pretty high, between the 20 and the 30. Last year was 15%. I mean, year to date is 15%, and that's what is bringing it a little bit down, 27. Book value continues to grow. It grows about at 8.5%. Return on equity, 31%. That's great. I normally look for a 15%. Return on assets, 23%. This is great. I normally look for a 5%. And return of invested capital, I look for above 15, and it is at 27%. That is just great. Dividend, there has been a couple, I believe these are special dividends. Everything else have been growing at about a 12% CAGR in the last 10 years. When it comes to debt, I wouldn't worry too much about the debt. It's, as you can see, is very low. So outstanding shares continue to decline, even though lately has been slowing down. And actually, if you notice here, it went up a little bit year to date. That's a CAGR in the last 10 years of negative 1.5. When you look at the financials, so we put it all together in the last 5 years, revenue has grown for 4%, earnings have declined 1%, free cash flow has declined 7%, book value 10%. Analysts are projecting that growth will actually decline to 5.6%, and that's once again thinking in a recession that might last a year or two, like it normally does around here in the United States. So here's the multiple valuations. So in the multiple valuations, for those that don't know, we take the revenue, earning, free cash flow, and book value per share, and with the dividends, we look at the average in the last 5 years, and we also look at the trailing 12 months. We multiply them by the last 10 years multiple, and this company, I like to do the 10 years because it has established companies, so that's pretty good. And these are the prices that we get, and with a fair value somewhere between $136 to $145. And if you remember, right now it's trading at $95. That is quite a difference when it comes to the upside. Payback time, if we were to believe the doubters and think that, okay, this is free cash flow is just going to grow about 1%. The reason why I put 1% is because I see it a little flat. So I'm just going to say, okay, what if it just stays like that? With the payback time in the next 15 years, it will take us 15 years if we pay $73 to get the money back. Or if we believe the average, which I think is a little high for the average in here at 7%. So I will probably be paying somewhere close about this number of $74. When it comes to discounted earning valuation, I'm using a growth of 5%, which is close to their 10-year average, a little bit more conservative. And then we will have at somewhere between $67 to $84 fair value. So these two numbers, as you can see, they're a little closer to what the what the analysts are kind of looking at. When it comes to earnings, owner's earnings valuation, which I don't know how good it is for this kind of company, we have a price of almost $180 to almost $200. So whenever we put everything together and we look at the averages, we have a fair value of somewhere between $125 to $144. And right now there's a lot of negative feelings. So if we were to put a 30% margin of safety, which is pretty nice, let's say that it stayed like this for the next 2 years and then it jumped to these fair value prices, that will still be at 15% year over year. If the assumptions pay, if you were to pay today's price at $94. So that is my assessment. This is what I have bought shares on T Rowe. And well, just let me know if you agree or disagree with that, and hope that you enjoyed it, and see you next video.